On March 19, 2023, Switzerland did something almost unthinkable in its consensus-driven financial culture. It forced Credit Suisse into the arms of its rival UBS. The stakes were bigger than one troubled bank. Credit Suisse, a Zurich-based global lender with deep ties to wealth management, investment banking, and cross-border finance, sat at the core of Switzerland's identity as a stable haven. In the post-2008 world, regulators rebuilt guardrails for systemically important banks, but the ultimate test is always liquidity under stress and public confidence. By early 2023, mistrust had become a self-fulfilling risk. The broader backdrop included rising interest rates, unrealized losses on safe assets across the industry, and a skittish market watching regional bank runs in the United States. In that environment, any hint of weakness could trigger deposit flight before formal capital metrics even budged. Swiss authorities, chiefly the Swiss Financial Market Supervisory Authority and the Swiss National Bank, were not merely referees, they were emergency engineers tasked with preventing a disorderly unwinding that could reverberate through Europe's funding markets and the global dollar system. Their interventions were framed as system stabilizing rather than blame assigning in real time. The cast of this drama had gathered over years. Credit Suisse's boards and successive executive teams wrestled with a persistent pattern, a powerful brand and client franchise undermined by recurring losses and compliance failures that eroded credibility. On the home front stood FINMA, the market supervisor, the Swiss National Bank as lender of last resort, and the Federal Department of Finance, empowered to authorize extraordinary measures in crises. Abroad, host supervisors and enforcement bodies watched closely. In the United States, the Department of Justice and the Securities and Exchange Commission oversaw discrete matters. In the United Kingdom, the Prudential Regulation Authority and the Financial Conduct Authority policed local risks. This was not jurisdictional confusion. It reflected a bank whose business spanned prime brokerage in New York, fund structures linked to London, and the heart of Swiss wealth management in Zurich. The interplay between home and host supervisors set the stage for the denouement of 2023. The timeline to the cutoff shows an institution accumulating bruises, then running out of time. In 2014, the bank entered a guilty plea in a U.S. tax case and paid heavy penalties, a cultural and financial hit that lingered. In 2016, the Mozambique tuna bonds affair surfaced, later evolving into enforcement and litigation over undisclosed sovereign-linked risks. In 2021 came two shocks in quick succession. First, Credit Suisse froze roughly $10 billion in supply chain finance funds connected to Greensill Capital after insurance coverage lapsed and exposures proved concentrated. Losses for fund investors were estimated in the low billions. Second, the Archegos family office imploded after concentrated, leveraged swaps moved against it. An internal review commissioned by the bank later put the loss at approximately $5.5 billion and documented deep failures in risk management. Through 2022, restructuring plans were announced and business lines repositioned, but confidence remained fragile. In the fourth quarter of 2022, clients withdrew on the order of $110 billion. A brutal reminder that liquidity can evaporate when wealthy depositors and markets doubt a turnaround. By mid-March 2023, against the backdrop of stress at several U.S. lenders, Credit Suisse shares and bonds were under pressure, credit default swaps surged, and counterparties trimmed exposures. On March 16th, Switzerland's central bank extended a large liquidity backstop. Markets steadied briefly, but skepticism persisted. 3 days later came the state-engineered merger with UBS, accompanied by extraordinary liquidity support. Mechanically, the vulnerabilities were not a single rogue line, but a system of incentives and weak second-line challenge. In prime brokerage, relationship managers and traders were paid to grow balances with sophisticated clients such as family offices. Total return swaps and margin arrangements with Archegos created concentrated exposures in a handful of correlated media and technology names. When prices fell and variation margin calls mounted, risk limits and early warning triggers failed to force rapid de-risking. The internal review described a culture that normalized exceptions, rewarded revenue, and diffused accountability, while basic risk hygiene, timely escalation, and a holistic view of aggregate client risk across entities broke down. In supply chain finance, Credit Suisse's funds effectively repackaged corporate receivables, originated by Greensill, sold to clients as a low-volatility cash alternative. The strategy relied on insurance to sanitize credit risk and on diversification that proved thinner than advertised once exposures linked to a small group of borrowers became apparent. When insurance protection faltered, the structure's safety narrative unraveled. Money and incentives pushed in specific directions. Wealth management prized so-called sticky assets and stable net interest income, but reputational hits scare high-net-worth clients quickly. Investment banking's prime services delivered steady fees until a concentrated client relationship turned catastrophic. Fund management gathered fees on the supply chain products that grew rapidly in low-yield years, while the actual credit tail risk sat in a black box that many buyers treated like cash. At the corporate level, bonuses and targets were tied to growth, cost-cutting milestones, and headline profitability. That encouraged aggressive timelines for fixies and a focus on optics while deep control work lagged. Meanwhile, funding markets quietly repriced the risk. Wider spreads, higher credit default swap premia, raising the bank's cost of wholesale funding, just as it most needed cheap liquidity. The squeeze intensified as some institutional counterparties trimmed lending lines and clients shifted deposits to perceived safety. Controls that should have worked, frontline risk ownership, independent risk and compliance, internal audit, often identified problems but did not impose the brakes early enough. The Archegos review criticized slow reactions to clear red flags and incentive schemes that failed to penalize excessive client concentrations. In the supply chain funds, governance failed to prevent over-reliance on one originator and a handful of end borrowers. Due diligence gaps around true economic exposure and correlation remained. Publicly, by March 2023, the bank disclosed material weaknesses in internal control over financial reporting, eroding market trust at precisely the wrong moment. When confidence snaps, liquidity stress outruns accounting capital. Depositors move first, wholesale markets second, and resolution options shrink. Enforcement and emergency measures up to the cutoff followed two tracks: long-running cases and immediate stabilization. Pre-existing matters include investigations and civil suits tied to Mozambique-related financings and the wind-down of the Greensill funds in multiple jurisdictions. Allegations were contested in courts and arbitral forums with the usual lag. In the acute phase, Swiss authorities executed a different playbook. FINMA announced it had approved the takeover of Credit Suisse by UBS, explicitly endorsing a solution crafted with the Swiss Federal Department of Finance and the Swiss National Bank. The central bank provided substantial liquidity assistance to support the transaction and the system, bridging a confidence gap that standard facilities could not fill under weekend time pressure. The terms were exceptional: a rapid merger of national champions under supervisory pressure to preempt a Monday market panic. Officials framed the move not as a bailout of equity holders who faced steep losses, but as a containment exercise to protect depositors and preserve the financial center's functioning. Victims and fallout extended beyond shareholders. The immediate losers were investors who had believed in the bank's self-rescue plan and discovered they were junior to the logic of systemic stability. Fund investors in the supply chain products faced years of uncertainty and staged recoveries after assets were frozen in 2021. Relationship managers confronted a credibility crisis with wealthy clients who had watched peers pull cash in late 2022. Rebuilding trust is a multi-year process even under a strong combined brand. Employees faced job insecurity and culture shock inside a merger that compressed two different legacies almost overnight. Suppliers and smaller counterparties reliant on Credit Suisse credit lines saw their funding assumptions upended. Market participants, across Europe especially, worried about contagion through derivatives and repo channels if the forced combination stumbled. In the wider system, the episode sharpened questions about too big to manage complexity, the limits of risk-weighted capital as comfort in the face of social media-accelerated bank runs, and whether supervisors should step in sooner when a franchise's credibility, not its reported capital, becomes the binding constraint. The lessons are concrete. Culture is a control. If exception-making becomes routine, concentration risk hides in relationship logic until it detonates. Diversification claims must survive a hard look at correlation and common originators. Insurance is not a substitute for genuine risk transfer if it can lapse or be contested. Liquidity is a narrative as much as a number. Once depositors doubt the story, cheap funding vanishes, and you cannot spreadsheet your way out of a confidence shock. Cross-border groups are judged on the weakest link. A US family office blowup or a UK-centric supply chain structure can trigger doubts about a Swiss wealth management core because clients perceive a single brand. Supervisors need credible, pre-funded liquidity backstops and legal powers that can be activated over a weekend without creating undue moral hazard. The Swiss action in March 2023 was a blunt instrument. The alternative, an open market Monday with widening runs, carried far greater systemic risk. For viewers, the due diligence signals are practical. If you allocate to bank paper or park large deposits, watch outflows closely. Management can promise a turnaround, but quarterly cash movements reveal client conviction. Read internal control disclosures. Declarations of material weaknesses are not boilerplate. Be skeptical of products sold as cash-like, yet backed by complex receivables or insurance layers. Ask who ultimately bears credit risk when the music stops. Track a bank's cost of funding relative to peers. A persistent premium is the market's verdict on trust, and an early warning that balance sheet strength on paper may not suffice to fend off a run. If you found this breakdown useful and want more clear, sourced investigations into financial blowups and market plumbing, consider subscribing and sharing this episode with someone who follows banking risk. It helps keep the focus on facts rather than hype.